If you are managing a massive retirement fund that you've been building for decades.
Or, even if you were just starting out with a couple $100 on a trading app.
Exactly. There is this universal feeling that unites every single person who steps into the market. And it is that low-level, stomach-churning stress.
Oh, absolutely. The dread.
Right, the dread that just one bad trade, like one impulsive decision, is going to completely wipe out your account. So today, we are doing a deep dive into a concept that is entirely designed to neutralize that dread.
It's a really necessary topic.
Yeah, we've got a stack of excerpts in front of us from a text called the 2% Rule, a comprehensive guide to risk management. And our mission today is to figure out what this strategy actually is, how you execute it in a living, breathing portfolio.
And honestly, whether it's the ultimate shield against market chaos or, as we'll see, just a massive administrative headache.
It is a fascinating debate because on the surface, the math of this rule looks so incredibly straightforward.
It does. But the deeper we go into the source material, the more we see that implementing it forces you to confront some, really uncomfortable truths about investing.
Yeah.
It touches on human psychology, our tendency toward greed, and our intense desire to impose control over an environment that is fundamentally chaotic.
So true. Well, let's start with the baseline definition. Before we get into all the exceptions and the psychological elements, what actually is the 2% rule?
Right, let's lay the groundwork.
The text outlines it as a voluntary risk management strategy, meaning, this isn't a regulatory requirement. The SEC isn't looking over your shoulder.
No one is forcing you to do this.
Right. It is a self-imposed restriction where you vow to never risk more than 2% of your total trading capital on any single trade. And the source notes it applies universally. Stocks, bonds, options, futures, forex, you name it.
Yeah, the universality is really the foundation of the whole philosophy here.
It acts as like a universal governor on your risk.
Exactly. The rule argues that it doesn't matter what specific asset class you are dealing with. The mechanics of capital preservation remain exactly the same. You're basically building an artificial floor under your portfolio to ensure that you survive to trade another day.
So to put this in everyday terms, it's kind of like walking into a casino with $100 in your pocket.
A very disciplined casino trip.
Very disciplined, and forcing yourself to never bet more than $2 on a single hand of blackjack. You could sit at that table for hours, have a terrible run of luck, and you are still not going to go broke immediately.
That analogy works really well to capture the defensive posture of the strategy. The text highlights this mathematical reality that it often surprises people.
Yeah.
If you strictly follow this rule, you could experience 10 consecutive losses.
10? Wow.
10 times in a row. Your analysis is wrong, the market goes against you, and you take a hit. After all of that, your total account is only drawn down by roughly 20%.
That's incredible.
Right, you still have 80% of your capital intact.
That is a stark contrast to how a lot of casual investors operate. I mean, I think many of us have thrown 20 or 30% of our portfolio into a single stock just because, we were convinced it was a sure thing.
We've all been there.
Yeah.
And that brings us to the core why behind the rule. The strategy fundamentally accepts a reality that amateur investors try to ignore, which is that losses are just an inevitable part of the business.
They really are.
The 2% rule builds a structure around that inevitability. It prevents the catastrophic drawdowns that make mathematical recovery nearly impossible.
Right, the recovery math.
Yeah, think about it this way. If you throw caution to the wind and lose 50% of your account on a bad trade, getting back to your starting point doesn't require a 50% gain.
Wait, really? Let me think about that.
Yeah, because you now have half as much money working for you. So you actually need a 100% gain on that remaining capital just to break even.
Oh, wow. Yeah, that makes sense, but it's brutal.
It is. So this rule is strictly designed to stop you from ever digging a hole that deep.
Okay, so the defensive theory makes total sense. But moving from theory to practice is where things got a little complicated for me when reading the source.
It's not as simple as it sounds.
Not at all. Because executing this isn't as simple as just dividing your cash and buying shares. The math actually works backward.
Yes.
You don't just say, oh, I have $50,000, so I'll buy $1,000 worth of stock.
Right. This is a super common misconception. You are not allocating 2% of your account size to purchase the asset. You are limiting your maximum potential loss to 2%.
Right.
To do that, you have to work backward from the safety net you set for yourself.
Let's use the Apple example from the text to see how this mechanically functions because I think it helps.
Right.
Say you have a total trading account of $50,000.
Right.
Under the rule, your maximum risk limit is 2%, which is $1,000. You want to buy Apple, ticker AAPL, which is currently trading at, let's say, $170 a share.
And you need a safety net.
Exactly. You decide to set your safety net, which is a stop-loss order, at $15 below that current price.
And for anyone unfamiliar, a stop loss is just an automated instruction to your broker to sell the stock if it drops to a certain level. It just stops the bleeding.
Right, so your perceived risk per share is that $15 drop. That is the literal distance between what you pay and where you pull the ripcord.
Exactly.
So the math is you take your total allowed risk, the $1,000, and divide it by your per share risk, the $15. That gives you roughly 67 shares.
But
The source points out we have to factor in the friction of the real world. If your broker charges a $25 commission for the whole trade, you have to deduct that fee from your $1,000 risk pool first.
you can't forget the fees.
Never forget the fees.
Yeah.
So you are left with $975. Divide that by the $15 stop loss, and you arrive at exactly 65 shares of Apple.
And there is your perfectly sized position.
Yeah.
If the stock drops $15, the broker automatically sells those 65 shares. You lose $15 on each, plus the commission, and you have captured total loss at exactly $1,000.
Which is 2% of your total account.
Perfect compliance.
On paper, it sounds foolproof. I mean, you map out the math, set the trap, and go to sleep. But the text throws some heavy caveats into this process.
It sure does.
It brings up terms like slippage and gap risk. And I really want to challenge the idea that this rule is a true safety net, because these concepts seem to suggest the math can just completely break down. Let's tackle slippage first. What is actually happening there?
So slippage is the difference between the price you expected to execute your trade at and the price the trade actually happens at.
Okay.
Let's say your stop loss is triggered at $155, but the market is in a free fall.
Like a panic sell-off.
Exactly. Everyone is panicking and selling at once. By the time your broker's automated order actually finds a buyer on the open market, just milliseconds later, the price might have slipped down to $154.50.
Oh, I see.
You lost a little bit more than you planned simply because of the sheer speed and liquidity of the market.
So the safety net sags a little bit. That's annoying, but it doesn't seem catastrophic.
No, not usually.
But gap risk, which the source also details, seems like a much bigger threat to the 2% limit. Walk us through what happens if I'm holding that perfectly calculated Apple position overnight. The market closes at 4 p.m., and then at 5 p.m., Apple announces terrible earnings.
Oh, that scenario exposes the absolute structural vulnerability of any stop-loss strategy.
Really?
Yeah. The stock market is not a continuous 24/7 auction. When terrible news hits after hours, traders react, but regular trading is halted.
Right, you can't really get out.
Exactly. So when the opening bell rings the next morning at 9:30 a.m., the stock doesn't gradually slide down to your $155 stop loss so you can gracefully exit.
It doesn't.
No. The opening price instantly reevaluates based on the new information. It might open right at $140.
Wait, so my $155 safety net is completely irrelevant? The price just teleported past it?
It leaped right over it. Your stop loss order is still sitting there. And once the market opens at 140, your broker executes the sale at the best available current price.
Oh, no.
Which means you just sold at 140. So instead of taking a $15 loss per share, you just took a $30 loss per share.
So across 65 shares, I didn't lose my intended $1,000. I lost almost $2,000.
Yep. Your carefully calculated 2% risk just doubled to a 4% loss overnight.
Wow. If gap risk can just shatter the boundaries of this rule, why rely on it at all? It seems like we are doing all this complex algebra just to comfort ourselves, when the reality of the market can override it whenever it wants.
Well, I wouldn't say the rule is just for comfort, but your skepticism is totally valid here. Gap risk is the nightmare scenario. It's a black swan event for a single stock.
Okay, sure.
But you have to weigh that against the daily alternative. The 2% rule assumes normal liquid market conditions, and the vast majority of the time, the stop loss functions perfectly.
That's true.
If you abandon the framework entirely because a gap might happen, you are trading a rare structural risk for a constant behavioral risk.
Ah, so we are shifting from the math of the market to the psychology of the investor.
Exactly.
Because the source lists the pros and cons of the rule, and the pros are heavily anchored in behavioral finance. It forces disciplined decision-making.
Because human beings are emotional creatures, especially when our life savings are fluctuating on a screen in front of us.
Right. The rule removes fear and greed from the moment of execution. Because you do all this backward math to find your 2% limit before you ever click buy, you completely prevent impulsive trading.
It slows you down.
You aren't chasing a hot tip from a neighbor by dumping half your net worth into a single speculative tech stock. By enforcing small 2% bites, it naturally pushes you into diversification.
It acts as a structural barrier against your own worst impulses. You are systematically neutralizing the urge to treat the stock market like a lottery.
Which is hard to do.
Very hard. But for long-term savers, this methodical approach is often the difference between steadily building wealth and blowing up an account entirely.
But let's look at the cons listed in the text because they highlight a really interesting tension. The primary drawback is that this rule aggressively caps your potential gains on high conviction trades.
It does.
If you have done the research and you are absolutely convinced a company is going to double in value, the rule still forces you to keep your position small. You miss out on the massive payday.
Yeah, that's the trade-off.
Consequently, the source notes that this conservative approach can lead to underperformance when compared to more aggressive growth strategies.
And this brings us to the core dilemma of all investing, the relationship between risk and reward. They are permanently attached to one another.
Two sides of the same coin.
Exactly. You cannot achieve outsized, aggressive returns without exposing yourself to outsized, aggressive risk. The 2% rule forces you to deliberately choose the conservative side of that spectrum.
It essentially makes investing boring.
Boring can be good.
Safer, sure, but undeniably less thrilling. And on top of being less fun, the source outlines how implementing the strategy creates a massive administrative burden.
Spreadsheet.
The spreadsheets.
Yeah.
The math isn't something you do once and forget about. Because the market is constantly moving, your portfolio's value is constantly changing, which means the 2% threshold is a moving target.
This is where the pristine math on a piece of paper meets the messy reality of a living portfolio. The constant shifting requires a process called rebalancing.
Let's unpack the rebalancing example the text gives using a fictional company, Tech Innovations, Inc., because it really illustrates the headache.
It's a great example.
Rather than getting bogged down in every single dollar amount, let's look at the mechanism. Imagine your entire portfolio is a pie chart. You've allocated your maximum 2% slice to Tech Innovations.
You are right at the limit. Perfect compliance.
Then the stock does exactly what you wanted it to do. It goes up in value. Your investment grows.
A good day.
A great day. But because that specific stock grew faster than the rest of your portfolio, its slice of the pie just got bigger. It now makes up, say, 2.2% of your total account.
And according to the strict parameters of the rule, you are now holding too much risk in one asset.
Right. So to get back into compliance, you have to sell off a portion of that winning stock. You have to shave that slice of the pie back down to exactly 2%.
It feels completely counterintuitive.
It really does. You are forced to trim your winners, the very stocks that are making you money, just to appease the mathematical formula.
It is counterintuitive emotionally, but from a risk management perspective, it prevents a single winning asset from slowly dominating your portfolio.
I guess that makes sense.
If you never trim it, a stock that started as a 2% risk could eventually become 15% of your portfolio. If that company then crashes, your initial risk controls are totally meaningless.
I get the logic, but the text adds a crucial, almost maddening detail about this trimming process. When you sell that little sliver of your winning stock to get back to 2%, you have generated cash. And you must immediately reinvest that cash into something else.
Right. The denominator of your equation has to stay active.
Exactly. Wait, let me rephrase that. The total size of your portfolio dictates what the 2% actually is.
Yes.
If you sell that sliver of stock and just withdraw the cash to, I don't know, buy dinner, the total value of your trading account shrinks.
That does.
And if the total account shrinks, the 2% limit shrinks along with it, which means all of your other investments might suddenly be over the new lower 2% threshold.
It causes a complete cascading effect. Every single time the total value of the account changes, the acceptable risk parameters for every single position in the portfolio change right along with it.
Trying to maintain that balance perfectly feels like trying to paint a massive suspension bridge. By the time you finish painting the very end of it, the beginning is already resting and you have to start all over again. It just never ends.
That is the reality of strict adherence. It requires a real appetite for administrative complexity, sophisticated tracking tools, and just constant vigilance.
Not for everyone.
Definitely not. For a casual investor with a small account, the transaction fees from constantly buying and selling tiny slivers of stock to rebalance the portfolio will simply eat away any profits.
Which naturally leads us to the alternatives provided in the source material. If the strict 2% rule is too rigid, or just too exhausting to maintain, how else can we put a governor on our risk?
Well, the text runs through a few established variations that offer some more flexibility.
The easiest one seems to be just adjusting the percentage.
Yeah, rather than managing 50 tiny positions at 2%, you consolidate.
Right. The text mentions capping allocations at 5% across 20 different securities.
Hmm.
It increases your risk slightly on a per-trade basis, but you are managing far fewer moving parts.
It's much easier to handle.
But then we get into some different structural approaches entirely. The text outlines the fixed dollar amount strategy. This is where you ignore percentages entirely and just decide, I am only ever going to risk $500 per trade, period.
It's incredibly simple to execute.
It is.
Yeah.
But the source notes a major flaw. It gets outdated as your portfolio grows.
You have to think about the math of compounding. If you start with a $20,000 account, risking $500 is a significant, meaningful chunk. It actually drives growth.
Right.
But if you are successful and over the years your account grows to $200,000 and you are still only risking $500 per trade, your risk profile has become so conservative that you are severely throttling your portfolio's ability to generate meaningful returns.
So are fixed dollar amounts basically just training wheels? Like a strategy that is useful for building discipline early on, but something you inevitably have to abandon as you scale up?
I think that's a very fair assessment. A static number just cannot adapt to a dynamic environment. You eventually have to manually adjust the dollar amount upward, which kind of defeats the whole purpose of having an automated systematic rule in the first place.
Yeah, that makes sense. The third alternative mentioned is risk-based position sizing. This one abandons universal metrics entirely.
It's a bit more subjective.
Yeah, the text describes it as assessing the custom risk-reward profile of a specific trade. You aren't relying on a hard mathematical cap. You are evaluating the specific scenario and allocating capital based on how confident you are and how the setup looks.
Which requires a significant amount of experience. You are reintroducing subjective judgment into the process.
And wasn't the whole point to remove that?
Exactly. The 2% rule exists to save novice investors from their own bad judgment. Risk-based sizing assumes the investor has developed enough expertise to accurately weigh those variables without letting emotion take over.
Which is a big assumption.
A huge assumption.
And finally, we arrive at what seems like the most advanced alternative, volatility-based position sizing. The text introduces some heavy financial concepts here, specifically mentioning adjusting your position size based on metrics like beta or standard deviation.
Oh, the dreaded math terms.
Right. For someone who sees those terms on their brokerage app but completely ignores them, how does this actually work mechanically?
Let's break those terms down because they really are crucial for understanding market behavior. Standard deviation is basically a measure of how far a stock's price normally swings away from its average.
Yeah.
And beta is a comparison tool. If the overall stock market is the ocean, beta measures how a specific boat reacts to the waves. The market itself always has a beta of exactly 1.0.
Okay, so the market is the baseline.
Right. If you buy a very stable utility company, it might have a beta of 0.5. It only feels half the turbulence of the overall market. It's a heavy, slow-moving barge.
Makes sense.
But if you buy a highly speculative tech startup, it might have a beta of 2.0. It swings twice as wildly as the market. It's a speedboat bouncing off every single wave.
So how does that apply to the size of your investment?
Volatility-based sizing dictates that you take larger positions in the slow-moving barges and much smaller positions in the erratic speedboats. You are standardizing the amount of movement you're exposed to, rather than just standardizing the dollar amount.
Oh, that feels like the most logical evolution of risk management.
Doesn't it?
Yeah, instead of slapping a blanket 2% rule over every single asset, regardless of its personality, you are adapting your defenses to the actual observable behavior of the specific stock.
It is highly sophisticated. It respects the unique characteristics of the asset while still maintaining a strict framework of preservation.
Well, we have covered incredible ground today unpacking these sources. To summarize the journey, the 2% rule outlines an undeniably useful tool. It imposes essential discipline on a highly emotional process.
Definitely.
It guarantees a level of diversification. And mathematically, assuming normal market conditions, it ensures you can survive a brutal, prolonged streak of bad luck.
And in the long game of investing, surviving your worst mistakes is honestly the only way to stick around long enough to benefit from your best decisions.
Very true. But the costs are real. It demands constant vigilance and an appetite for rebalancing spreadsheets. It invites transaction fees that can bleed a small account dry.
Yes.
And for the aggressive trader, it means sacrificing the possibility of a massive life-changing windfall on a single high-conviction bet.
You are intentionally trading the lottery ticket for the probability of steady survival.
As we wrap up, I want to leave you, the listener, with a final philosophical question drawn from the contradictions within the text itself. The source admits two realities. Losses are an inevitable part of trading, and specific market events can surpass the intended risk limit, which is that gap risk we explored.
Right, the sudden overnight drops that jump right over the safety net.
Exactly. So if losses are truly inevitable, and an unpredictable overnight event can instantly override a perfectly calculated 2% stop loss, is strict mathematical risk management ultimately just an illusion of control?
Hmm.
Are we diligently sitting at our desks, running complex algebra, and endlessly rebalancing our portfolios by microscopic fractions simply to soothe our emotional brains? Or does all this math genuinely shield us from the wild, unpredictable reality of the market?
It really pushes you to ask how much agency we actually have when we participate in the global economy.
It is a profound question to chew on the next time you are staring at those flashing red and green numbers on your screen, wondering whether to click buy or sell. Thank you for joining us on this deep dive into the source material. We hope this exploration helps you view your own portfolio and your personal relationship with risk through a sharper lens. Until next time.